Well, welcome to the second edition of the Weight Watchers show from Good Business Pays this year. The first one was with Blair McDougall last month. This is the second edition. I'm Terry Corby, the founder of Good Business Pays. And this is the podcast, of course, where you can find out everything you need to know about late and slow payment to small businesses. We've been running this for a couple of years now. I'm delighted today to be saying that we're heading in a slightly different direction than just straightforward payment practices for a change. We've started to think about how the world of investment and investors are interested, or not, of course, in the whole area of payment culture. And to help us think through that and to give a perspective, we have two folks who are really knee deep in all of that. We have Caroline Escott from Railpen, and we have Daniel Jarman from the Pension Protection Fund. This is an interesting time for us to hear about these organisations. Railpen, in case you didn't know, a lot of people might not know, is the major UK pension fund and investment manager of the Railway Industry Workers Fund. Actually, my first job was on the railway, and I think I've got about 3 years of pension fund to come to me afterwards. So maybe I'm a member somewhere of that. That's Railpen, and it has around £35 billion worth of assets that it looks after and 350,000 members. So it's a big and important organisation. And Daniel Jarman from the Pension Protection Fund. The Pension Protection Fund is the UK-backed, government-backed organisation that looks after pension funds and pension members where the company that had the pension fund has gone bust and the members of that fund are no longer going to get paid what they were owed. So very, very interesting. And I'll start, I think, today, Caroline, by asking you about Railpen. Give us a sense of the organisation beyond what I've just said, and also tell us about your role in the organisation, please. Welcome.
Thank you very much, Terry. Really pleased to be here today. So, adding to what you had said, we are really the in house asset manager for the Railways pension scheme. And we take a very active approach, a really bottom up approach to thinking about stock selection. We manage the majority of our investments in house. And I think that will be particularly interesting as context for the conversation we're going to have today. We are 44% invested in the UK. So 44% of that 35 billion that you mentioned is invested in UK companies and UK assets. So the UK for us is a really important market in terms of specific companies. But of course, we also think about wider market resilience. And that is really where my role comes in. So I am head of investment stewardship and co-head of sustainable ownership. And I and my team work with our internal portfolio managers to understand the biggest environmental, social, and governance financially focused risks facing the companies we invest in, but we also think about making sure that markets work effectively overall so that our overall portfolio is managed as effectively as possible.
Terrific. Right. Lots of questions that come from that. Daniel, same question to you. The Pension Protection Fund, I hope I've done it justice in terms of talking about it, but I'm sure you'll do a better job. Tell us about the PPF and your role, please.
Yeah, great. Thanks, Terry. Yeah, so I'm the Stewardship Manager for the Pension Protection Fund, part of the investment team based in the City of London. We operate a global portfolio across all asset classes. We have like significant like private market investments, but we're also invested in the like global equity markets. Of course, we have significant investments in the UK. And a number of those have been covered in the press recently. In terms of my role, not only do I work with the internal investment team, overseeing the internally managed portfolios, but we also oversee the stewardship and ESG like processes within our external investment managers across the asset classes. So not only are we operating on the front line, undertaking the investments, but we also get to oversee external managers as well.
Okay, well, let me stick with you, Daniel, for the moment. And one thing that I'm very interested in, obviously, Good Business Pays has been working in the area of payment culture for 6 years now and trying to help improve it. But why is payment culture of interest to you at PPF? Is it a question of morality or financial materiality? What's really your interest in this whole payment culture area?
Yeah, so from the point of the PPF as a whole, we have established sustainability policy. Part of this policy obviously considers like our own payment practices, and we have a payment practice policy. So like 30-day maximum payment expectations. From an investment perspective, though. Like looking at like the payment period for companies, that's not particularly new in terms of like equity investment like analysis. I think what has developed, or to be honest, I needs to develop more, is so that to move from the equity analysts a financial metric perspective into the ESG teams like perspective across the industry more.
And is that, if there were issues from an ESG perspective, is that a red flag for you all when you're looking at potential investments then? What's the outcome of that analysis that you just mentioned?
Yeah, so for the PPF at the minute, it's not part of like our voting policy. We use an external engagement like voting overlay provider. They're aware of the topic, but it's not currently part of their like established engagement and voting policy. And that's the area where it does need improvement. Hopefully, the recently announced legislation will improve that flow. But at the moment, it's not something that is as widely considered as it should. In prior roles I've had, it has been like part of the like governance oversight like considerations there, but at the moment for our external provider it's not.
And so, Caroline, this voting policy thing, it's probably, to a lot of people listening to this, they won't actually understand what that means and how
Mhm.
important that is to the processes that you look after. Perhaps you could explain, what does it mean when somebody talks about the voting policy? How does that fit into this story? And I think maybe at Railpen you've taken a slightly different or more progressive approach to this. Would that be right?
We have certainly been thinking about this for some time and undertaking some actions accordingly. So maybe before I get onto the voting policy bit, it's worthwhile unpacking a little how Railpen has been thinking about this in recent years. Everything we do on sustainable ownership, or ESG, is driven by financially material considerations. So what are those issues that are most likely to have an impact on financial outcomes for members of the railways pension schemes? And so we think about all the different issues that could be material to portfolio companies. And for us, if a company has a good payment culture, then we see that as a green flag that potentially that company has an effective governance, it is managing its financial operations well, and it's got a culture that really recognizes and seeks to manage all the risks and opportunities that are facing its business model. Conversely, and to Dan's point previously about sort of equity analysis and so on, when we are working with internal investment managers to look at a company and they've got a history of late or outstanding payments, we really see that as a governance red flag, as well as potentially being an indicator of hidden financial stress. So we think that actually that could crystallize in terms of reputational risk, in terms of greater regulatory scrutiny, and also higher operating costs as well. And the evidence base for that is really well established. A few years ago, Railpen decided to build on some of the research that we'd done previously on this and actually incorporate lines around our expectations as to how companies will behave on payments practice into our global voting policy. And for those listeners who might not be aware of what this is, investors will have a number of different tools with which they seek to engage with companies to work together with them to improve behavior on material issues. And that will include meetings. You could meet with an investor, obviously, either individually or as part of a group of interested shareholders. But it also includes tools like voting at a company's AGM. And that is a very public expression of either sanction for a company or support for a company's behavior. And so when we put something into our globally published, and we send this out to all UK companies and all of our priority holdings as well, voting policy, what we're really doing is signaling to the market what our expectations are on material issues like payment practices and how we will vote. And we could vote against, for instance, the director we deem responsible where these expectations are not met. And I think when we first produced these lines 3 or 4 years ago, we were the first global investor to do so. I'm not sure whether any other investors have followed suit. I'd be really keen to encourage them to do so because the evidence and the financial materiality to our portfolio companies in terms of later outstanding payments to suppliers is very clear.
And why do you think that more folks like yourself in similar roles in other organizations haven't picked it up as fast? Because I'll just add on to that. I know that in the US, for instance, ESG has got a tricky time at the moment, and there are lots of things in that ESG bucket, I understand. But this one we can see from some of the big construction companies and infrastructure companies that have gone bust in the past, and I'm sure Daniel will be aware of these too. Obviously the big one like Carillion, but there's been Midas and many others that have just gone bust and left a trail of destruction behind them. Given that the evidence is there around financial materiality, why haven't more people picked it up, do you think?
I think there are a few reasons. Railpen is very lucky in that we have the strong backing of our trustee and our ExCom for doing work on financial material ESG, which means that we have a team that is the right size to be continually reviewing and refreshing the evidence base on the financial materiality of particular issues. I think we also benefit from having a very close relationship and two-way dialogue with our internal portfolio managers. And the piece that Dan was saying previously is absolutely right, that often this issue around payments practices can be seen more as a traditional equity analyst issue as opposed to an ESG issue. But because at Railpen we work on this internally, because we are rare amongst pension schemes in doing a lot of our management internally, sorry, just removing a cat who wants to get involved in the conversation, that has helped us take a really rounded perspective and given us the backing we need to be able to do this research. I recognize what you say about US developments and the term ESG becoming increasingly politicized. At Railpen, we see that politicization actually as an opportunity for the industry to mature. And because we at Railpen have always focused on what is financially material, we feel comfortable to continue talking to the companies about the issues that matter most to them and to us in terms of good financial outcomes for our members.
So your sense is that this is going to become more important or as important as it has been in your analysis work, at least?
I think so. I think partly because asset owners are beginning to have more influence on their stewardship activities, including voting. And asset owners, pension schemes like myself and Dan, as representatives of two large ones in the UK, or asset owners, are truly long-term investors that can take a really long-term view on these kinds of issues. So I think it will become increasingly more important. I also think, again, as Dan said, that this latest package of measures from the government will really help crystallize in investors' minds some of the pathways through which poor payment practices can become financially material.
So Dan, that was Caroline's response to that question. From your perspective, though, what are companies, what are finance directors, heads of procurement, executives in large companies, what do they need to be thinking about in terms of payment culture, how important it is from your perspective, and what's your advice?
Yeah, great. So in terms of our payment culture, and how that's viewed through an investment lens, you've got the long like standard like equity research, the buy and hold long investors, um, who will look at this as like a health metric of the company. On the other side of the fence, there's also the absolute return, like hedge funds, that I know also look at this as a health metric, but not in terms of like long positions, in terms of short positions. Um, so when this metric deteriorates, that is a recognized weakening metric, which hedge funds will look at, and as you've seen with a number of companies in in the UK and globally, like significant short positions are building, add to the pressure that the company's under in terms of what like the future expectations of their performance. So yeah, it's much more. It's not only like a long story; it's also a short story. In terms of like financial risk, though, to companies, withholding payments from like particularly smaller companies can really damage these companies, not only like in terms of like their ability to grow, but the amount of like credit they have to take from banks, which come with an interest rate, so they're actually having a slice of their um, like margins, which could have been used to grow the company, become more successful, going to the banks. Like in the like extreme cases, the withholding of these payments can lead to companies going out of business. Which, if this is a key material or part in terms of your supply chain, can have really significant implications on the success of your larger business. So withholding those payments can have like, significant unintended consequences, and running that risk or elevating that risk um, is that it's not that there's very rarely good justification for that.
Yes, and of course, with all the problems that smaller businesses, well, actually, to be fair, all businesses are facing at the moment, lots of challenges. But if you look at smaller ones, resilience and the supply chain resilience is a big deal at the moment, right? There are so many factors that could put a smaller business out of business. You don't want to be causing more problems just by withholding payment, which seems to be quite on the face of it, an easy thing to fix.
Yeah, absolutely.
Okay, back to you, Caroline. In terms of talk about supply resilience a little bit, because you've spoken at our Fast Payer Awards before, and one of the things, and it's emerging in this conversation here actually, is that payment is important, but there's another element of it as well, which is actually the supplier relationship, the partnering relationship, having that resilience, that innovation in your supply chain. One of the things that we've done at Good Business Pays is now we've been running the Fast Payer Awards for 6 years, is we've studied the behaviors of the fast payers and how they interact with and partner with small suppliers. We had a sense that payment would be one thing that would get you through the door as a good behavior, but what would the 6 or 7 other things that those serial fast payers do that are different to others, and we've been able to bottle it. Is supplier resilience and that partnering something that is also of interest or importance at all to you, Caroline, in your work?
It is, Terry. So when we think about the companies that we invest in, we want to know that they will always be able to do what they need to do in order to meet all the challenges and opportunities facing their business model. And because in today's very interconnected world, so many of them have really very complicated supply chains in the UK, around the world, it's really important that those supply chains and their relationships with people across that chain is as smooth and efficient as possible. And we've seen recent research, including in this government paper that was out recently, to show that actually there are suppliers who will refuse to do business with a company that has a record of late and outstanding payments. And for a supplier relationship to be damaged in that way can really have a significant impact on the portfolio companies that we invest in as well. So it is something that we take very seriously indeed at Railpen.
Okay, good. So, Caroline, so the government has announced many changes.
Mm.
Planned changes, not changes yet implemented, but if they do all come to bear, and I'm relatively confident that they will be the strongest payment regulations of anywhere in the G7. So what is your view on what's been announced? Give us some sense of what you think about it all.
Thank you. Overall, we are very, very supportive of this package of measures. I'd spoken previously about how these measures would really help crystallize for investors some of the routes, will help bring to bear for investors some of the routes through which poor payment practices can crystallize in terms of material impacts. I think that the measures would help give investors the information they need in the annual report and accounts by companies who are not pursuing good payment practices. The annual report and accounts for investors is the most important communication that we receive from a company, because it concentrates in one place how a company is thinking about its future, about the risks it faces, how it will manage those, how it has managed those. And it helps us understand the story of a company and whether or not it's going to be a good investment for us or a bad investment. So having that disclosure as to what is going to be happening on improving payments practices, I think will be really important. It also ensures, this package of measures, that a key issue, material issue, gets discussed at the board level. And I think having that board level conversation, that board level scrutiny and challenge will really help give those CFOs who want to do more on good payment practices the support they need, the resources they need to fix whatever needs to be fixed in order to improve their approach. So I think it's really very important. I think it's a very positive package of measures, and I think this will really help investors get to grips with and raise awareness amongst investors of this financially material issue for member outcomes.
And on the annual report, I know that that's an important one for you, as you mentioned. Imagine for a moment that big company X is going to publish its annual report next week. You're used to reading these documents year after year, and there are lots of things in those documents that you will look for. Where in the document would you like to see payment practices represented? Because it might end up being on page 179 somewhere in a footnote. It might end up being somewhere. From a best practice perspective, where and how would you like to see that information presented?
So, as with any material information about a company's practices and operations, we would expect this to be raised really upfront, possibly in their disclosure of key risks and then how they're planning to tackle them. And even if it's a particularly egregious approach that they've taken so far, possibly even mentioned in some of the additional narrative reporting and statements from the chair and CEO as well, we would certainly now expect to see it as part of the audit committee or other board committee disclosures as well in terms of what they're planning to do. But really, some of these, as you mentioned, Terry, some of these board committee disclosures and reporting can be very lengthy. And even within those important sections, things can get obscured. So it would be great to see the plan of action, why this is an issue, right up front, and prioritize and highlight and beautiful formatting and all of that kind of good stuff, so that investors can really pick it out. I will say that actually there are a growing number of tools to help investors wade through the many hundreds of annual reports that we have to read every year. So I think chances are increasingly good that we'll be able to pick it out wherever it is. But as with all material issues facing a business, I think we agree that this is a really material one. We'd want to see it given due prominence.
And Dan, for you, is this information that your teams or your colleagues would be looking at as well, do you think?
I get like it's the same answer as before. Yeah, I'm not sure if it's in the quantitative model.
Okay. So for you, Dan, what would enable you to do more? I'm using the word more quite broadly there. If you wanted to do more in this area, what information, disclosures, or is there anything that you can think of that will enable you to do more analysis or better analysis, or your colleagues, that doesn't exist today?
As Caroline mentioned, seeing it like better discussed in like the front half of the annual report is always useful. Seeing it like covered in the like risk like mapping by the company would be useful also. But we do see a number of like the material risks already covered there. So whether for every company it should form part of that risk profile, I'm not sure. But certainly getting it into the front half of the annual report, like more prominently, would be beneficial. But ultimately, whilst this stays something, in terms of, so something the finance director would oversee, and it's one of dozens of metrics used by equity analysts, it's not prominent enough, certainly at board level, to warrant like the further consideration. And the way that consideration is often given is by being raised by the fund managers, which I'm sure it is, when these figures are deteriorating. But there's a number of cases where they're not deteriorating. Like a company just has a history of being like a relatively slow payer, which is also an issue from the perspective we're taking today. But yeah, seeing that almost from a systemic point of view, which a number of investors are given more weight to now. Seeing that move up the like materiality, like risk register in terms of stewardship will be beneficial, and get those discussions taking place with the board when meetings take place. So this is a step which I believe needs to be happening.
And there are about 25%, 25% of large companies that should be reporting their payment figures that actually don't at all. What would you say either to them or about those?
I would say that probably the most fundamental thing you can do as a company is fulfill your regulatory requirements in whatever area of the business they might happen to be. And actually, if that isn't happening, that raises real red flags for us in terms of your internal controls, your compliance, and your culture, including the tone from the top, because I would expect the board and I expect senior managers and ExCom to be paying very careful attention to making sure that the basics, like meeting your regulatory requirements, are covered. So I would take that extremely seriously as a shareholder in that business.
And what would you say to other people in your roles and in the investment community around? You clearly are passionate and a great advocate for what we're talking about here out there in front. But what would you say to other people in your position in other organizations like yourselves around why they should take, why is this important?
So, from my perspective, I think the research on the financial materiality is clear. This matters to you as an investor in companies that are responsible for making payments, but also as an investor in the UK bit of your overall portfolio in resilient financial markets. The other thing I think I would say to investors, based on my conversations with CFOs and finance directors at some of our portfolio companies on payment practices, is that yes, some companies are genuinely treating payment practices as an opportunity to help manage their cash flow, and seeing it in quite a cynical way. But there are others who are genuinely struggling to prioritize payment practices on their to-do list and get the board level support that they need. So it's up to us as shareholders, when we are interacting with the board, where there is a company that has really good payment practices, we need to offer our support and make sure that's flagged to the board so they know it's an important matter and a material matter for us, or to challenge the board and ask the board to look into this. And of course, this latest package of measures from the government should really help deal with that issue. But shareholders need to be working on that and engaging with boards on that as well.
And may I ask, do you still use Good Business Pays data in your, do your teams use it in their analysis work? I don't know if
We
that's
do. We do. So what Dan was saying around how lots of interesting information is already disclosed is absolutely right. But as investors, we like having centralized information, centralized databases for a particular pool of companies. And so that's one of the reasons why the Good Business Pays Fast Late Payers list is so important, and it's formally incorporated and cited in our voting policy each and every year and part of our analysis. But also coming back to that piece around reporting on your plan to tackle poor payment practices in your annual report is also really important, so that investors can see this piece of your story all in one place. Centralization of data, gathering of data, structuring of data in a way that is useful for investors is very important for us.
right? Well, we're coming towards the end. This has been really good, a real education for me, actually. Dan, back to you for just, I guess, one more summary question. Do you think more generally that we're likely to see a change of emphasis, let's say more importance going towards the topics we've talked about in terms of payment culture? I understand that it's already established, but in terms of fundamental governance, in terms of sustainability, ESG, things that are looked at, do you think this is going to be seen as more important in the future more generally?
This should be part of that wider conversation, making sure that companies are able to flourish in the UK without having to worry about like the delays in payment. Because of course, whilst the money's not in your pocket and it's in someone else's, you're running the risk within the supply chain of things going wrong. So yeah, that's an unfair transfer of risk in many cases. And with risk, lowers the growth appetite, which we need companies to have.
Great. Caroline, same to you to finish off here. What do you see as the future in this area and how it's going to develop?
I think more investors are going to be paying attention, partly as asset owners with a long-term time horizon continue to take on more stewardship control and influence and engage ever more intensely with asset managers where they use them on material issues, and also prompted by this very important government package of measures, which I am very supportive of and very much hope will continue sort of unhindered and exactly as they are set out here as well. I think that the work of Good Business Pays is really important in raising awareness and spreading the word. I think the work of investors and shareholders also needs to be kicked up a gear. Myself, Dan, others, we will do what we can to encourage shareholders to work together with their portfolio companies and with government to try to achieve a more resilient UK growth that is founded on good payments culture and practice.
Well, thank you for that. I must say that alongside other conversations that I've had with senior executives in business and government representatives, etc., it feels like the debate around if this is a problem that should be fixed is now done. It feels like there's lots of nodding heads everywhere saying this is a problem that needs to be fixed. And in more cases than not now, our conversations are moving to how? How should we do it in our different areas of work? And importantly, why we should do it. If we pay faster, what's the outcome of that? For the big company, for the investor, for the small company. So we will continue our work and start to look much more, I think, towards the how and the why, rather than just making the same argument, which I think has been won. So, Caroline and Dan, thank you very much for your time today. It's been a pleasure and an education, and we look forward to seeing where you take this. Thank you.
Thank you for having us.
Thanks, Terry.